All right, everybody, welcome to lecture video 6, and this is actually going to be our last video for chapter 4. So congratulations, you've made it this far, and we're almost through it. We're almost done, and this video is actually going to be a rather easy, rather short one, okay? And in this video, we're going to be covering a brand new statement called the Statement of Changes in Equity. So I feel like the best way, just how I presented, the statement of retained earnings to you guys, I feel like the best way to present the statement of changes in equity is to just, show you the most complicated possible version of that statement. And then we'll go through, line by line and dissect exactly what is going on and the calculations that are being used in order to present that statement. So without further ado, this is what, the complicated statement looks like right here. So as you can see, it actually looks massive. It looks like a huge statement here, but when you break it down, there's actually not that much going on in the statement, okay? And you'll see that as we move forward. But before we just dive in, I want to kind of give an overview of what the statement is. So, as the name suggests, the statement of changes in equity is just a statement that showcases all of the changes that have happened to each individual shareholder's equity account. As you can see on the statement here, from left to right, we list all of our individual shareholders' equity accounts. We got our common shares, preferred shares, contributed surplus, so on and so forth. We list out all of our shareholders' equity accounts from left to right, and then, we list off our beginning balances for each of them, and then showcase all of the activity that happened throughout the year that, either increased or decreased the account. And then we just finish off with our ending balance for each one of these shareholders' equity account items. That's basically all it is. It's just giving you a breakdown of each individual shareholders' equity accounts. So we'll go through it and we'll look at each individual account and what is happening for each one. So the first one here is our common shares account. So for those who don't know, common shares account just basically is representing the value of the common shares that the company has outstanding. Okay, so to start off the statement, we list our beginning balance. In this case, it's $400,000. And then we list, any activities that have happened throughout the year for this particular account. Now, for common shares, you're only ever going to see one thing that affects this account, and that is issuing more common shares. Okay? So in this year, we issued more common shares of $131,000. And this actually increases the account. Right? So the last step here is to record our ending balance, and we're just going to take our $400,000 beginning balance and then add our issuance of more common shares of $131,000 to figure out our ending balance of $531,000. That's all it is, right? Very easy, common shares, because only one thing happened during the year, and that's what you're going to see throughout this course. Only one thing happens to common shares, and that is issuing more. Preferred shares is the next part of the statement of changes in equity that we're going to record, and it's the same thing as common shares. We list our beginning balance of $250,000, and then the only activity you're going to see throughout the year is just issuing more preferred shares. In this case, we issued more of $75,500. Therefore, our ending balance for the year is just $250,000 plus $75,500. Giving us an ending balance of $325,500. Very simple, right? You may be wondering, what the heck's the difference then between common shares and preferred shares? And there are some technical differences for the shareholders who hold those particular shares, but there is absolutely no difference between the two in terms of how we prepare the statement of changes in equity. Okay? List the beginning balance, add any issuance of common shares or preferred shares, and then find out our ending balance. And that's it. The third step here is to show our contributed surplus account. Okay? And contributed surplus is a very complicated account. In fact, it is so complicated that it's actually out of the scope of this course. You're going to see it a lot more in Intermediate 2, but in this course, no, you're not really going to see it that much. And it actually is annoying why some of the questions you're going to see when you practice include this account in it, because It is very complicated and it shouldn't be a part of this course, but again, sometimes it sneaks into some questions, so that's why I'm including it here now, so that I can give you my explanation of it and my point of view, so that if you see it in a question, it doesn't catch you completely off guard, okay? So just to give you a little bit of background of the account, what it is that when we issue common shares and preferred shares, we usually issue it at a par value, okay? Usually, like, for example, like $40 a share or whatever. But sometimes the selling price ends up going up above par value when there's a lot of demand for those shares. And in that case, we incur this gain between the selling price and the par value. And that gain becomes our contributed surplus. Now, if you didn't understand any of that explanation, then just don't worry about it, okay? If you're confused by it, just forget about it, because for this course, you really don't even need to know what the account represents and what it stands for. I just figured I'd tell you in case any of you guys were interested. All you need to know is that it goes on the statement of changes in equity. And how do we, showcase it? All we're going to do is list our beginning balance of $130,000, and that's it. After that, we just list our ending balance, which is going to end up being the same as our beginning balance. So in this case, it's also $130,000. Like I told you, contributed surplus is completely out of the scope of this course. And that is why we're not going to ask you or show you any activity that happened in the account, because it's just too complicated right now for you to understand. So if it does end up sneaking its way into a question, you're only ever going to be expected to record the beginning balance and ending balance for contributed surplus. The fourth step is to list and show everything that happened to retained earnings. And as you can see here, what is happening in the retained earnings section is the same thing that happens on the statement of retained earnings. We list our beginning balance, add or subtract any changes in errors or retrospective adjustments, add our net income, and then subtract any cash dividends or stock dividends paid. That's it. And that's the exact same that happened in the statement of retained earnings that I talked about in lecture video 5. So I'm not going to go into depth and explain what's happening here. If you were lost, or in case you haven't seen lecture video 5, I suggest you go and watch it, because that's where I actually explain what happens to the retained earnings account and why we are, adding net income, why are we subtracting stock dividends. That's where I kind of go over it. But for those who have seen lecture video 5, then there should be nothing new here for you. It's basically a repeat of what we just talked about last lecture video. The fifth step here is to actually show the comprehensive income. And this is where it gets very weird. Comprehensive income isn't even a shareholders' equity account. I don't even know why we put it on the statement. It's so out of place, so unnecessary. I mean, we've already calculated it on the income statement, so I don't know why we show it on the statement of changes in equity, but for some reason, we do. Okay, so you're going to be expected to know this and to put it on the statement. Okay, I think it's very weird why we do it, but that's just the way, the big people up top make the standards. Okay. They want to see it on the statement, so that's what we do. So we already know how to calculate comprehensive income. Just take our net income of $167,000 and then add or subtract our other comprehensive income of $45,700, giving us our comprehensive income of $212,700. What I do want to point out to you, though, is note how the comprehensive income, the $212,700, is recorded one line above all of the individual accounts' ending balances. And that is because, since comprehensive income isn't actually a shareholders' equity account, we're going to record it on its own separate line there, just so that we don't get it confused with the ending balance, so that we don't accidentally include it in our calculations in the total column. Okay, so that's just one little thing I need you guys to keep a lookout for. And then the last step, the sixth and final step for the statement of changes in equity, is to list our accumulated other comprehensive income. Okay, so this is the last shareholders' equity account that you may see on the statement. Okay, and this account, you wouldn't have seen it before, but it's not too hard to understand what it represents. Basically, other comprehensive income is closed off to accumulated other comprehensive income every single year. So this account basically just represents all of the other comprehensive incomes for all of the prior years, since it is closed off every single year. So as you can imagine, what are we going to record in this section? We're first going to obviously have our beginning balance here of $223,400. But the only, activity that's ever going to happen in this account is just add in or subtract in our other comprehensive income for the year. We're basically just closing it off. So, in this case, we had other comprehensive income of $45,700. So, that's what we put in this section of the statement. And then, last step here is to figure out our ending balance of accumulated other comprehensive income. Take our beginning balance of $223,400 and add our other comprehensive income of $45,700, giving us our ending balance of $269,100. And then that's how you prepare the statement. Just list out all of your individual shareholders' equity accounts, list the beginning balance, show any activity that happened in the year that affected this account, and then find our ending balance. After that, add up everything that happened in these columns to, solve for the total column on the far left. And once you've done that, the statement is complete and you're finished. And with that, that brings us to the end of our Chapter 4 lecture videos. I hope you have found these extremely helpful. And I hope that, with the knowledge you have gained from these videos, you'll be able to go forth and apply them on the practice questions in the textbook. And that, the material will come a lot easier and it'll be a lot smoother for you to complete. And if you guys are still struggling with the material after watching all of these videos, then, I suggest you guys to go ahead and watch some of the solution videos that I have posted, which may, break down some of the questions and help you, push forth any plateaus that you may be struggling with in terms of grasping the material. So again, I thank you for watching these videos and I hope they've been helpful.